Hello everyone. Today we are taking a deep dive into this CNN business story, Big Banks' gloves come off in their fight with crypto. We are going to break down exactly what is going on between Wall Street and the crypto world and what it could mean for your money. But before that, you are watching Decode Daily News, where we take the biggest business and finance stories and decode them so anyone can understand. If you are not subscribed yet, hit that button right now. So let us get into it. The Dimon-Armstrong tension isn't new. So that line really caught my attention, and here is why. Jamie Dimon and Brian Armstrong have been on opposite sides of the crypto debate for years. Dimon has called crypto a fraud, a pet rock, and worse. Armstrong has built the biggest crypto exchange in America. These two were never going to agree. But something shifted recently, and it matters a great deal. Let us see what is written ahead in this same news paragraph. But it is boiling over publicly as the Senate inches closer to a floor vote on the crypto industry's No. 1 legislative priority, known as the Clarity Act. And here is what that really tells you. When powerful people start fighting in public, it usually means the stakes just got real. The Clarity Act is not some minor regulatory tweak. It is the biggest piece of crypto legislation America has ever been this close to passing, and everyone with money on the line is now scrambling to shape it before it becomes law. Based on what we know, a Senate vote could come at any point in the near term, and both sides are pushing hard right now. Now this is the part I could not move past. Dimon, a longtime crypto skeptic, broadly supports crypto regulation, but takes issue with a provision in the Clarity Act. And think about what that actually means. Even the biggest crypto skeptic on Wall Street is not saying kill crypto entirely. He is saying regulate it, but regulate it properly. That is actually a more nuanced position than most people give him credit for. He is not anti-crypto. He is against loopholes that let crypto companies skip the rules everyone else must follow. And then came the part that says it all, that would allow companies like Coinbase to effectively pay interest on deposits without the protection they should have. And that one line changes everything. This is the heart of the entire fight. Coinbase wants to offer rewards on your money, which sounds great on the surface. But bank deposits come with government insurance. Crypto exchange deposits do not. So if Coinbase can offer interest like a bank, but skip the safety nets, a bank must carry customers get the upside with no protection on the downside. And most people will not realize that until something goes wrong. Here is the piece that reframes everything. The Clarity Act is rattling Wall Street and consumer advocates alike. Now sit with that for a second. It is not just bankers complaining here. Consumer protection groups, people whose entire job is to protect everyday investors, are also raising serious concerns. When both Wall Street and consumer advocates are sounding the same alarm, that is worth paying close attention to. And the reason behind it tells you even more. Because of its promise to weave crypto, a historically self-contained financial system. And here is the part that hits different. Right now, crypto and traditional banking are mostly separate worlds. Your savings account and someone's Bitcoin wallet do not really affect each other. That separation has actually protected a lot of ordinary people from crypto volatility without them even realizing it. And that brings us to the part at the center of this whole story, more fully into the machinery of traditional finance. And think about what that actually means. But if this bill passes as written, that separation starts to dissolve. And once crypto risk is woven into the same system that holds your mortgage, your retirement account, and your savings, a crypto downturn stops being someone else's problem. It becomes everyone's problem, whether you own any crypto or not. Now this is the part I could not move past. It's not just a crypto story, and here is what that really tells you. A law professor who studies both banking and cryptocurrency is drawing a much bigger picture here. She is saying, do not get distracted by the crypto headline. The real story underneath is about how much deregulation is quietly being slipped into this bill. From what experts are observing, this could reshape the entire investment landscape, not just the crypto corner of it. And she did not stop there. It's a broad deregulation of our securities markets story. Hilary Allen, a law professor at American University who specializes in banking and cryptocurrency, said, "Now let that sink in." Securities markets are the backbone of how wealth is built and protected in this country. Stocks, bonds, investment funds, all of it runs on rules designed to prevent fraud and protect ordinary investors. If those rules get quietly loosened under the cover of a crypto bill that affects everyone, not just crypto holders, everyone with a savings account, a pension, or any financial future at stake. But that was just the beginning. The bill would allow crypto firms to offer financial rewards to customers for using stablecoins, and that is not a small thing. Stablecoins are designed to hold a steady value, usually 1-to-1, with the dollar. So when a crypto firm offers rewards for holding stablecoins, it sounds almost identical to a savings account paying interest. That comparison is exactly what the banks are furious about, because banks have to follow strict rules to offer that same product. Crypto firms under this bill would not have to follow those same rules. And that brings us to the part at the center of this whole story, a kind of digital proxy for US dollars. And think about what that actually means. A digital proxy for dollars sounds harmless and even modern. But here is the thing, if it walks like a bank deposit and talks like a bank deposit, customers will treat it like one. And when people assume their money is as safe as it would be in a bank, without actually having that protection, that is where real financial damage happens to real people. Now, this is the part I could not move past. The immediate concern from banks and many consumer advocates is that crypto exchanges like Coinbase would, in the grand tradition of Silicon Valley innovation. And here is what that really tells you. This phrase, in the grand tradition of Silicon Valley innovation, is doing a lot of work. It is not a compliment. It is a warning. Silicon Valley has a long history of disrupting industries with bold promises and then rewriting the terms once customers are locked in. Banks are saying crypto will do exactly the same thing here. And they are not wrong to be worried. And that brings us to the part at the center of this whole story. Lure customers in with huge rewards. And think about what that actually means. Come in with incredible offers. Sky-high returns. Zero fees. Get people hooked. Build the loyalty. Then quietly dial it back. This is not a new playbook. We have seen it with ride-sharing apps, with food delivery platforms, with buy now, pay later services. The offer at launch almost never survives contact with profitability pressures, and the customers who chase the big rewards end up holding an uninsured account with shrinking benefits and no real safety net. And then came the part that tells you even more, and then phase those benefits out over time. And here is the part that hits different. The long game is the real concern, not the launch offer, the exit from it. When banks change a product, there are regulatory guardrails in place. When a crypto exchange does it, the rule book is still being written. And under the current version of the Clarity Act, customers may have very little recourse when those rewards quietly disappear. Here is the piece that reframes everything. She notes that the FTX implosion of 2022 was bad for crypto investors. And here is what that really tells you. FTX was one of the biggest crypto collapses in history. Billions of dollars vanished. Customers lost everything they had on the platform. It was devastating for the people inside the crypto world. But if you had no crypto, you mostly watched it happen from a distance. Your bank account was fine. Your retirement fund was largely untouched. That distance is exactly what experts are now warning could disappear if this bill passes. And that is only half the story, but the fallout was largely contained within the digital asset ecosystem. Now let that sink in, contained. That is the word that matters most here. The FTX disaster stayed inside its lane. But as traditional banks invest in crypto under federal regulation, the next major failure may not stay contained. It could spread into your bank, into the broader market. Not because you own any crypto, but because the institutions that hold your money now do. So that is exactly where my take comes in. But real quick, before I give you my take, this video is for educational purposes only, not financial advice. Always do your own research before making any investment decisions. So, here is what I think is really happening right now. Both Dimon and Armstrong want this bill to pass. They just want different versions of it. And that tells you the real fight is not crypto versus banks, it is about who gets to write the rules. From what we can observe, Jamie Dimon and the major banks are actively pressuring lawmakers to remove the stablecoin rewards provision before any floor vote happens. That is not a small ask. That is a fundamental change to the bill's core offer. What concerns me most is the consumer protection gap. If crypto firms can offer interest-like rewards without the same safety nets banks are required to carry, people will chase those higher returns without fully understanding what they are giving up. High reward with hidden risk is one of the oldest traps in finance, and most people only discover that trap after it has already closed around them. The integration argument is the one I keep coming back to. Right now, a crypto downturn stays mostly in the crypto world. Once this legislation passes and large banks lean into crypto under a federal regulatory umbrella, the next major failure in this space could ripple across the whole financial system, not because you invest in crypto, because the institutions managing your money do. Based on my reading of this situation, that risk is not being talked about loudly enough. So watch this space carefully. Lawmakers are still debating this. Whatever version passes or does not pass will tell you a great deal about who Washington is actually working for. Keep your eyes open and your risk tolerance honest. If you found this breakdown useful, hit that like button and subscribe so you never miss an episode of Decode Daily News. And I want to hear from you. Do you think crypto firms should be allowed to offer interest-like rewards without the same rules banks are required to follow? Drop your answer in the comments below.